Commonly used real estate terms. Term definition. Absorption. The change in occupied space from period to period. This helps measure how much new space was taken up during the quarter. Vacancy measures how much is vacant, but this can be impacted by new construction, buildings taken off the market, etc. Absorption measures the growth in used asking rent. The amount of rent that a landlord is advertising for a space, generally quoted as the dollars per square foot per year. This helps narrow down initial tenant options for space. Tenants may negotiate this rent downward from the asking space.g rate. Base year. The base amount of operating expenses in the year that the lease is signed. These are the expenses covered by the full service lease. A tenant in a full service lease may still have to pay for their share of any increasing expenses over the rate in the year they signed the lease. This protects the landlord in case costs skyrocket, energy. Capital expenditures. Property improvements that cannot be expensed as a current operating expense for tax purposes. Examples include a new roof, tenant improvements, or a parking lot. Such items are added to the basis of the property and then can be depreciated over the holding period. Distinguished from cash outflows. For expense items such as new paint or plumbing repairs, operating expenses that can be expensed in the year they occur. Capitalization rate. A percentage that relates the value of an income-producing property to its future income, expressed as net operating income divided by purchase price. Also referred to as cap rate. Cash on cash rate, a return measure that is calculated as cash flow before taxes divided by the initial or current equity investment. Class A, B, C. Relative classification of buildings in terms of finish, amenities and physical attributes. A Class A building will cost more, but will also offer a tenant some increased efficiencies including upgraded wiring, fiber optics, lobbies, etc. Class A properties also have nicer lobbies and shared areas, and often better views. Common area maintenance. CAM. Common area maintenance is a fee paid to the landlord in addition to rent to maintain your office space. There are two types of CAM fees: variable and flat. Fees are based on total rentable square footage and represents a pro rata fee of the total maintenance charges for the building. These fees can include anything from insurance, repairs, landscaping, cleaning services, utilities, snow removal, security costs, and more. Sometimes it can include administrative and management fees and salaries. 1. Concessions. Discounts given to tenants either as money off on a lease or free rent, paying moving expenses, etc. A part of a lease package that helps a tenant compare different lease options. Some concessions are more useful to tenants than others, either by shifting costs further into the future or paying for large upfront expenses. Debt coverage ratio, DCR. Ratio of net operating income to annual debt service. Expressed as net operating income divided by annual debt service. Demographics. Characteristics of human populations as defined by population size and density of regions, population growth rates, migration, vital statistics, and their effect on socio-economic conditions. Due diligence. The process of examining a property, related documents, and procedures conducted by or for the potential lender or purchaser to reduce risk. Applying a consistent standard of inspection and investigation can determine if the actual conditions do or do not reflect the information as represented. Easement. An easement is a non-possessory right of the use of, and estoppel. A signed statement that summarizes the terms of the lease. Usually executed by the tenant. This is typically required by a lender when a building is being sold or refinanced. A lender often requires signatures from all the tenants that the lease terms are accurate in order to finance a loan. Fair value of an asset or liability. The amount at which the asset or liability could be bought or incurred or sold or settled in a current transaction between willing parties, that is, other than in a forced or liquidation sale. First mortgage. A first mortgage is a mortgage whose lien is superior to the lien of any other mortgage on the same property. This lien is superior either because it was recorded prior to all other mortgages or because the mortgagee of another mortgage which had been recorded ahead of this mortgage has agreed to have a lien subordinated to the lien of this mortgage. Government incentives, concessions given or measures taken by local or regional government to attract firms or investment dollars to a given locality for the purposes of promoting economic growth and encouraging development. Ground lease. A lease of the land only. Usually the land is leased for a relatively long period of time to a tenant that constructs a building on the property. A land lease separates ownership of the land from ownership of buildings and improvements constructed on the land. 2. Internal rate of return, IRR, the percentage rate earned on each dollar that remains in an investment each year. The IRR of an investment is the discount rate at which the sum of the present value of future cash flows equals the initial capital investment. Loan-to-value ratio, L/V, the amount of money borrowed in relation to the total market value of a property, expressed as the loan amount divided by the property value. Net lease. A lease in which the tenant pays, in addition to rent, all operating expenses, such as real estate taxes, insurance premiums, and maintenance costs. Net operating income, NOI. The potential rental income plus other income, less vacancy, credit losses, and operating expenses. Net present value, NPV. The total cost or gain of something, a lease term, a building hold period, when compared over the same period of time. This makes it possible to compare the relevant cost or gain from two different lease terms, two different sales scenarios that may have different time frames. It takes into account the future sales gains or costs of the deal as well as the costs now and costs in between. Non-recourse note. A non-recourse note is a type of note in which the borrower has no personal liability for payment. Operating expense stop. A negotiable amount at which the owner's contribution to operating expenses stops. It also can be stated as the amount above which the tenant is responsible for its pro rata share of operating expenses. Parking ratio. The number of parking spaces per 1,000 square feet of space. This determines how many people can park on site. Percentage rent. The additional rent, over a base amount, that is paid by tenants to owners on tenant sales over a specified dollar amount. It is frequently found in retail leases, also known as overage rent. Phase 1 study. Phase 1 is a study to determine the potential environmental hazards that exist on a property. Things like prior uses, on-site storage tanks, asbestos, and lead-based paint are taken into consideration. A lender is the one who will insist on having something like this done because they don't want an environmental issue to arise that will drastically decrease the value of the property they have a loan on. Real estate investment trust. REIT. An investment vehicle in which investors purchase certificates of ownership in the trust, which in turn invests the money in real property and then distributes any profits to the investors. The trust is not subject to corporate income tax as long as it complies with the tax requirements for a REIT. Shareholders must include their share of the REIT's income in their personal tax returns. 3. Replacement cost. The estimated cost to construct, at current prices, a building with utility equivalent to the building being appraised, using modern materials and current standards, design, and layout. Sale-leaseback. When a company sells their building to an investor and then signs a long-term lease for the space, providing income for the investor. A company that owns a building may have a good portion of their money tied up in real estate. Selling the building and leasing it back can allow them to use more of their money to expand their business and can also provide tax benefits. Securitization. The phenomenon of indirectly investing in real estate markets in ways that minimize risk, for example, investments made collectively with pooled money, or the use of investment packages forward/funds, such as mortgage-backed securities, sold on the secondary financial market, as opposed to direct investments. where investors own property or hold mortgages. Square footage, rentable. RSF. Rentable square footage, RSF, is the total usable square footage plus the shared spaces of the building. This includes the shared lobbies, hallways, restrooms and storage areas, which you pay for. To calculate RSF, you need to determine the common area factor. To do so, divide the total floor area by the usable square footage. On average, the common area factor ranges from 1020%. Square footage, usable. USF. Usable square footage, USF, is the actual space you can occupy in a commercial rental property. Non-exclusive spaces such as lobbies, restrooms, stairways, hallways and storage rooms are not included in USF. However, if you lease an entire floor, restrooms and hallways would be counted as usable square footage since it is exclusive to your company. To calculate USF, subtract the shared square footage from the total floor area. Sublease. A lease in which the original tenant, lessee, sublets all or part of the leasehold interest to another tenant, known as a subtenant, while still retaining a leasehold interest in the property. Also known as a sandwich lease due to the sandwiching of the original lessee between the lessor and the subtenant. Tenant improvements. The amount of money given to a company to improve the space, this money is used to repaint or carpet, add offices or make any other improvements to the space. The landlord will grant a certain amount of tenant improvement dollars in the lease. Additional dollars desired by the tenant for extra touches can be added into the lease. Title insurance. An insurance policy that protects the holder from loss sustained by defects in the title. 4. Triple net lease. A lease that represents only the rent on the space. The utilities, taxes, etc. are paid separately by the tenant. This is more common in industrial properties, because industrial companies may spend hugely different amounts for power, in sales tax, etc. depending on what they do. 5.